On May 11, 1931, Vienna's Creditanstalt Bank admitted it had lost 140 million shillings, nearly its entire capital. The announcement shattered Europe's financial peace, triggering a panic that would topple banks, currencies, and governments within weeks. Creditanstalt wasn't just any bank. It controlled two-thirds of Austrian industry. When it revealed staggering losses on May 11, 1931, the government rushed to guarantee its deposits. But this promise was impossible to keep. Austria's reserves were tiny, and the bank's hidden debts were far larger than anyone knew. The guarantee only raised the stakes, tying the state's fate to a sinking ship. The crisis had been brewing for years. After World War I, Austria was a shrunken empire with a bloated banking sector. Creditanstalt absorbed failing rivals. But what looked like strength was actually a secret burden. By 1929, it had taken over the troubled Boden-Creditanstalt, inheriting massive bad debts. The merger was disguised as a rescue, but planned at a time bomb inside Austria's most vital institution. As the panic spread, Austria turned to the League of Nations for a loan. France agreed to help, but with a brutal condition: Austria must abandon a customs union with Germany. This political demand turned a financial rescue into a diplomatic crisis. Austria refused, and the loan collapsed. Without international support, the run on Creditanstalt became unstoppable. The panic leaped borders. Germany's banks were already fragile, loaded with short-term foreign debt. When Creditanstalt fell, investors pulled funds from Germany too. On July 13, 1931, the giant Danube Bank closed its doors after the collapse of its major client, the textile firm Nordwohl. The German banking system was now in free fall, and the government had no clear plan to stop it. With Germany on the brink, an emergency conference in Basel froze short-term credits. The standstill agreement of August 1931 was a desperate tourniquet. It halted withdrawals, but also shattered confidence. Banks stayed closed for weeks, and businesses starved for cash. The bailout saved the banks, but strangled the economy, proving that a rescue can sometimes deepen a crisis. The contagion reached London. Foreign creditors, spooked by German losses, began pulling gold from the Bank of England. Britain's reserves dwindled. On September 21, 1931, the unthinkable happened. Britain abandoned the gold standard. The pound plummeted, but the move gave the economy room to breathe. It was a forced sacrifice that broke the global monetary order, but saved Britain from a deeper depression. Across the Atlantic, the U.S. Federal Reserve watched the chaos unfold. Instead of injecting liquidity, it raised interest rates to defend the dollar's gold parity. This decision, made in October 1931, was catastrophic. It exported deflation worldwide, crushed American banks, and turned a European panic into a global depression. The Fed's inaction was the final blow that locked the world into years of misery. In Vienna, Berlin, and London, the consequences were brutal. Unemployment soared past 25% in Germany. Austrian industrial output halved. Savings vanished overnight. The crisis wasn't just numbers. It was families losing homes, businesses shuttered, and a generation scarred. The banking collapse directly fueled the political extremism that would soon engulf Europe. The 1931 crisis taught a harsh lesson. In a globalized financial system, no bank is an island. Creditanstalt failure spread because of interconnected debts, fixed exchange rates, and political squabbles. Today, the same mechanisms exist: cross-border lending, currency pegs, and delayed bailouts. The names change, but the chain reaction remains the same. The Austrian guarantee was meant to calm markets, but it backfired by tying the state's credibility to a doomed bank. This moral hazard, where rescues encourage reckless risk, is still with us. In 2008, similar guarantees triggered sovereign debt crises in Ireland and Greece. The 1931 playbook was reopened, and the outcome was eerily familiar. Every major decision in 1931 came too late. Austria hesitated to reveal losses, Germany delayed capital controls, and the Fed refused to act until the damage was done. The crisis proves that speed matters more than size in a bailout. A swift, decisive intervention might have contained the panic. Instead, delay turned a bank failure into a global catastrophe. In 2023, when Credit Suisse teetered, regulators moved fast. They forced a merger with UBS over a weekend. That speed was a direct lesson for 1931. But the underlying vulnerabilities, hidden leverage, political interference, and cross-border exposure remain. The next crisis will test whether we've truly learned the lesson of Europe's banking collapse, or if we're doomed to repeat it. What would you have done? Tell us in the comments. Subscribe to Ledger Noir and uncover the stories money try to hide.